Let's start though with the markets, as we always do here on NYSE Live. Joining me now in studio with more is Kevin Mon, President and CIO at Hennian and Walsh. Kevin, it's great to see you this morning.
It's great to be back, Kristen.
All right, let's talk these markets. Fractionally lower today, but still hovering near record highs. What's your take?
Yes, we're seeing a lot of rotations developing in the markets thus far in 2026. Small caps outperforming large caps, value outperforming growth. International stocks continuing to outperform U.S. stocks, emerging markets over developed markets, and now technology has taken a backseat, and we've seen sectors such as energy, materials, industrials leading the way. That's very interesting to me as a portfolio manager, because I'm not necessarily abandoning some of the more thematic trades that actually provided all the growth in 2025 and 2026, but I do want to start diversifying my portfolio to take advantage of some of those rotations that have developed.
Okay, interesting. So certainly we've seen that in 2026. Do you anticipate that to be a theme throughout the year or a more near-term strategy?
I think that's a longer-term diversification strategy, but to me, this is going to be a year filled with much more short-term bouts of volatility, as we've already seen thus far this year. But if you're going to look for true growth opportunities, you need to follow the money. Follow the money in terms of where all the money is going to continue to be spent. I know you have Kevin O'Leary coming on shortly talking about AI infrastructure. That's one of the areas where money will continue to be spent. But it's also going to be spent in aerospace and defense, power solutions, nuclear power solutions, natural gas power solutions that are necessary for the AI revolution to continue, and then, of course, healthcare as it relates to the biotech trade.
Let's talk about earnings. We're toward the tail end of earnings season now. Some of these consumer retail stocks starting to report. Collectively, what is your takeaway from earnings season so far?
Another strong earnings season. 75% have beat earnings estimates, 65% have beaten revenue estimates. We're on track for about an 11.9% year-over-year earnings growth rate for the S&P 500. If that holds, Kristen, that would mark the 5th consecutive quarter of double-digit earnings growth for the S&P 500. Not too shabby. To me, that's a sign that this economy right now looks pretty strong. If you think unemployment fell to 4.3%, GDP growth looks like though it's going to be around 3.6% for the fourth quarter. Inflation is moderating, earnings is growing. Fed doesn't need to cut interest rates right now, that's for sure.
All right, so let's talk about that, takeaways from these Fed minutes, because I think they did surprise some market watchers just in terms of how cautious the officials seem to be when it comes to lowering borrowing costs.
Correct. I think investors shouldn't be looking to the Fed for too many answers this year, because the Fed doesn't need to provide too many answers because of the Goldilocks economic conditions that exist right now. Not too hot, not too cold. Perhaps 2 rate cuts during the second half of this year. Certainly nothing during the first half of this year. And I think they're right to perhaps point out that if in fact inflation does get out of control, we may need to step in, raise interest rates, but that's obvious. They don't even need to say this. I think we're going to learn more on Friday about core PCE, which is their preferred inflation gauge. If that follows CPI, well, then that's a good sign for the economy.
Are you looking at economic projections for jobs and inflation for the year? Of course, the Fed's dual mandate.
I am. If I look at what the Fed is forecasting right now, they believe unemployment will end the year at 4.4%. We're about 4.3% right now, so stable. They're considering the economy is going to slow to 2.3%. We're about 3.637 right now. That would be slowing, but still growing. And then if I look at their forecast for inflation, core PCE 2.5 this year, 2.1 next year, it gets closer to their 2% target. I think that's a relatively stable outlook for the economy. That means the Fed doesn't need to do much, perhaps lower 2 times 25 basis points each, and the economy will continue to grow, but not at a gangbuster pace.
You mentioned bouts of volatility that we could see this year. It is a midterm election year, and we've been hearing right from market participants that that might come along with that based on history. Are those buying opportunities?
Potentially, it depends on what pulls back. So if I look at what's taken place in the AI trade over the course of the last 3 weeks, the current area that's under the microscope, software. Their amount of spending that's taking place right now, will it actually lead to any meaningful ROI? Is it going to improve their business practices? All those are valid questions. But I think investors need to be patient with respect to the AI spend right now, because that ROI will not be achieved for years down the road. But if you follow where the money is being spent as opposed to who's spending it, that leads you to data center construction companies like EMCOR. That leads you to data center cooling companies like Comfort Systems or Modine Manufacturing. That leads you into the power solutions and utility companies. That's where I see the opportunities. So if those areas pull back, I think that's a very attractive entry point.
Are there specific stocks on your radar?
Other than the ones I just listed, I like a utility company called Duke Energy.
Yep.
Duke Energy actually owns and operates 6 different nuclear power plants in North Carolina and South Carolina. They got a dividend of 3.3, forward-looking PE of around 18. And they hold up well in the face of volatility. And guess what? Their stock's up 10% year to date. Not too bad.
They were here at the New York Stock Exchange this week.
Saw it.
Yes, indeed. You did, Kevin. So, okay, we talked about economic data. We talked about earnings. We talked about the sectors. I do want to talk more broadly about international stocks.
Yes.
You had mentioned, obviously, emerging markets and developed markets, I should say. But what are you seeing when it comes to developed international markets?
Yes, very, very interesting right now. Over the course of the past 1 year period, international stocks have significantly outperformed U.S. stocks. Emerging market stocks have outperformed developed markets. So developed markets over the last year up over 30%. So where do you find the opportunities there? Well, if you look into the indexes, it's really healthcare and financials that are the largest market cap weightings in those international developed market indexes. More of a value play, and value is leading growth this year, so that makes sense to me. But more than anything, this just serves as a reminder to all investors who are watching the show right now of the benefits to diversifying your portfolio globally. I think the U.S. will continue to lead the way, but that doesn't mean you don't add some allocations to international stocks as well.
Anything else our viewers should know?
I think what we really need to pay close attention to is what comes out in that core PCE reading. If we come in below 2.8%, that shows that inflation is moderating. If we get above 2.8%, then now all of a sudden the hawks are going to come back out and they're going to suggest that no rate cuts this year, and the market isn't expecting that.
Okay, we'll be following that closely. Kevin Mon, he's president and CIO at Hennian and Walsh. Kevin, thank you so much.
Thank you, Kristen.
Great to see you.